Today, I'm going to walk you through the fundamentals of a financial model to equip you with the knowledge you need to engage with investors and other key stakeholders. What's up, everyone? My name is Luciano, and welcome to the Bergden Group YouTube channel, a channel for entrepreneurs and small business owners. So today's agenda looks like this. First, I'll provide a conceptual explanation of what a financial model is. I'll then talk about the two approaches to building a financial model. And lastly, I'll go over the outputs produced by a model. Now, here's a quick disclaimer. This video is not a step-by-step tutorial in Excel of me building a model. This video is simply to educate people and viewers on the concepts and fundamentals at a high level of what a financial model is and what it's for. So everything I'm about to tell you comes from my experience working as a venture capital financial analyst. The experience and training I received from working in venture capital and evaluating hundreds of businesses is what I'll be using. So what separated good businesses from great businesses? Simply put, it was their financial model. It conveyed that they knew their numbers, had a clear strategy, and could articulate how their strategy translated into value for investors and other key stakeholders. So let's ask ourselves a simple question. What is a financial model? A financial model is simply a tool that's typically built in Microsoft Excel to forecast a business's financial performance into the future. Now, this forecast is typically based on the company's historical performance, assumptions about the future, and requires preparing an income statement, balance sheet, cash flow statement. So there are two types of models, a top-down and a bottom-up. And a top-down, you work from a macro or outside-in perspective towards a micro view. In essence, the top-down method helps you to define a forecast based on a market share you would like to capture within a reasonable time frame. Here's a short example. I am going to capture 1% of the $70 billion coffee market within 5 years. That's top-down. The bottom-up approach is less dependent on external factors, but leverages internal company-specific data and business drivers such as sales, production capacity, monthly volume, CapEx, financing, etc. So contrary to top-down, the bottom-up approach begins with an inside-out view and builds towards a macro or big picture view. And here's another example. Imagine you own and operate a specialty coffee shop and want to model the shop's performance over the next 12 months. Let's assume the main driver is foot traffic to your location. So one of your key strategies is selecting a prime location with a high level of foot traffic and demand for specialty coffee. So you can derive your assumption for daily foot traffic from publicly available data or doing your own analysis by counting the number of patrons walking by and into your shop. You can now estimate the rate at which those passing by and walking into your shop make a purchase multiplied by, let's call it an average transaction price or ticket price. So you now have something to build off of or model. Now, the modeled assumptions produce outputs. Those outputs are financial statements, a P&L, which is the income and cost your company has generated over a specific period of time and shows you whether you are profitable or not. The P&L shows several crucial performance metrics such as the gross margin, EBITDA, and net margin. These are all very important for investors as it provides insights into the operational performance of a company and allows them to compare efficiency when comparing different companies or investments. Now, the balance sheet. The balance sheet is an overview of everything a company owns, its assets, and owes its liabilities at a specific point in time. It shows a snapshot, for instance, in the month of December, and is therefore different compared to the P&L statement, which shows all revenues and costs that were generated during a certain period of time, January through December. Now we have a cash flow statement. The cash flow statement shows all cash going in and out of the business over a specific period of time, again, January through December. And so the cash flow statement consists of three different parts: operational cash flow, investment cash flow, and financial cash flow. And so the separation of these three categories provides you with insights on where money is going in and out of the company. Operational cash flow shows the cash inflows and outflows caused by the core business operations of your company. Investment cash flow shows changes in investments in assets and equipment, and financial cash flow relates to the cash changes arising from financing activities such as debt or equity. And so this allows management to make informed decisions on business operations and allows it to prevent and monitor the company debt. Moreover, it helps define a company's investment needs and supports the timely payment of expenses and other obligations. So this concludes my first video of this series covering financial models. Please stay tuned for more videos going into topics discussed here in greater detail. Alright guys, props to you for staying tuned throughout this entire video because you are on your way to building your toolbox of financial modeling skills. Please leave a comment down below if you found this helpful or if there are other topics you would like me to talk about. Now, it would mean the world to me if you click the like button and subscribe to my channel down below. Thank you so much, and I look forward to providing you with more information.